$45,283. That is the additional cost the average American pays over a lifetime of borrowing simply because their credit score is fair instead of good. Not bad, fair. LendingTree, 5-loan lifetime study. Most people believe the credit score system was built to help them. It was not. It was built to help lenders. And the distinction costs the average American $45,000. The credit score is not a government system. It is not a public utility. It is a product sold by a private corporation to banks. The Fair Isaac Corporation, FICO, launched the first standardized credit scoring model in 1989. Its customers were lenders, not consumers. The score was designed to answer one question for one audience. How likely is this borrower to repay? The borrower was the subject. The lender was the client. Today, 90% of top lenders in the United States use the FICO score to make credit decisions. Every mortgage application, every car loan, every credit card decision, filtered through an algorithm that belongs to a publicly traded company that generated $1.6 billion in revenue in fiscal year 2024. That is not a conspiracy. It is a business model. And understanding it changes how you read every number the system assigns you. The FICO score is calculated from 5 factors. They are public. They have been public since 1989. Most Americans have never read them. Payment history, 35% of your score. Whether you have paid your bills on time. A single missed payment stays on your credit report for 7 years. Amounts owed, 30%, not the total amount you owe. The percentage of your available credit you are using. This is called credit utilization. The system recommends keeping it below 30%. Length of credit history, 15%. How long your accounts have been open. A person who has never needed credit is penalized. The system rewards debt history, not the absence of debt. Credit mix, 10%. Whether you hold multiple types of debt at once and new credit, 10%. Whether you have recently applied for more debt, 65% of your score is determined by 2 factors: whether you paid your previous debt on time and how much of your available credit limit you are using right now. The system is measuring your relationship with debt, not your financial health, not your savings rate, not your income, your relationship with debt. Here is what the score actually costs. In the 4th quarter of 2025, the average new car loan rate for a borrower with a super prime credit score was 4.66%. The average rate for a borrower with a deep subprime score was 16.01%. Same car, same loan amount, same dealership, different score, different price. Experian, State of the Automotive Finance Market, 4th quarter, 2025. On a $30,000 car loan over 60 months, the difference between excellent and poor credit is more than $13,000 in additional interest. That is not the price of the car. That is the price of the score. The mortgage calculation is more severe. A borrower improving their credit score from 620 to 760 on a $300,000 30-year mortgage saves $56,103 in interest over the life of the loan. That is not a rounding error. That is a year and a half of median household income, determined by a score built for lenders. More than 1 in 3 Americans currently has a credit score. Below the threshold, most lenders classify as prime. In absolute numbers, more than 47 million Americans fall into the subprime borrower category. These are not people who are reckless with money. The average FICO score in the United States is 717. A score of 717 is classified as good. It is also the median. Half of American adults score below it. Among millennials, approximately 40% held subprime credit scores. The generation that entered the workforce during the financial crisis carried the highest student debt load in history and faced the most expensive housing market ever recorded, was then told their credit score reflected their financial character. Here is the mechanism the system relies on, most people never understanding. To build a good credit score, you need credit. To get credit, you need a good credit score. This is not a bug. It is how a system built for lenders functions. When it encounters a person with no credit history, the Consumer Financial Protection Bureau uses the term credit, invisible to describe Americans who have no credit score. Because they have no credit history, they are not bad borrowers. They have never borrowed, and the system treats the absence of debt as a disqualifying characteristic. A person who pays for everything in cash, carries no debt, and has never missed a payment has no utilization ratio. The system cannot score them. The FICO system does not measure whether you are good with money. It measures whether you are good with debt. Those are not the same thing, and confusing them is the most expensive financial mistake most Americans make. A LendingTree analysis calculated the total cost of carrying a fair credit score across 5 standard types of borrowing versus the same borrowing with a very good credit score. Total interest paid over a lifetime of borrowing at fair credit rates, $257,781. At very good credit rates, $212,498. The difference, $45,283. The largest single component is the mortgage. A borrower with fair credit pays approximately $29,000 more in mortgage interest than a borrower with very good credit. On the same house, the second largest is the credit card, $5,600 in additional interest, assuming minimum payments on an average balance. The system that penalizes you for high credit utilization also profits from the interest you pay when that utilization is high. Here is what the ledger shows on the American credit score system. A private corporation built a scoring algorithm in 1989. Its client was the lending industry. The score it produced measures debt behavior, not financial health. It is used by 90% of top lenders to set the price of every loan, mortgage, and credit card in the country. More than 1 in 3 Americans currently scores below the prime threshold. The lifetime financial penalty for that score is $45,283 in additional interest. The formula is public. It has always been public. Payment history at 35%. Amounts owed at 30%. Both measured in the context of debt, not savings, not income, not financial discipline. The credit score system is not broken. It is working exactly as it was designed to work. For the institutions that built it. The question is whether it is working for you. There are 4 actions that move a credit score. Each one is derived directly from the 5-factor formula. Pay every bill on time, every month. Payment history is 35% of the score. A single late payment costs more than any other action you can take. Automate minimum payments, so a missed deadline is impossible. Keep credit utilization below 30% of every card's limit. Amounts owed is 30%. If your combined limit is $10,000, keep the balance below $3,000. Do not close old credit card accounts. Length of history is 15%. A closed account shortens your average account age. Keep old accounts open with small recurring charges. Do not apply for multiple new credit lines at once. New credit is 10%. Multiple applications in a short window signal desperation to the system. Space applications by 6 months minimum. These are not hacks. They are the formula, published by the company that owns the score. The people who act on them pay $45,000 less than the people who do not. The credit score system will not explain itself to you. The algorithm is proprietary. The formula weighting is published but buried. The lifetime cost of a fair score is not advertised by the institutions collecting it. The Wealth Ledger publishes verified financial data every week. No predictions, no opinions. Subscribe at newsletter.wealthledger.co. The data is free. The $45,000 is yours. The FICO system was built by a corporation for lenders. It has been running for 36 years. It will not change on your behalf. The ledger never lies.